You hear trading and investing thrown around a lot, right? And sometimes people use them like they're the same thing, but they're really not even close. They're two totally different ways of thinking, almost like two separate worlds operating in the same stock market. So let's break down what really separates a trader from an investor, because figuring this out, well, it's pretty darn important for your own money.
Okay, when I say stock market, what's the first thing that pops into your head? Probably something like this, right? The yelling, the chaos, papers flying everywhere on the trading floor. It's the classic scene from the movies. But here's the big question. Is that what investing is? All that frantic energy? Well, maybe. Or maybe it's something else entirely. And getting that distinction right is absolutely key if you want to understand how real wealth is actually built.
All right, so let's get right to it. The biggest, most fundamental difference between an investor and a trader. It all comes down to one thing: time. That's it. It's this constant battle between patience and pace, and believe me, it shapes every single move they make.
And when I say time, I mean the difference is just huge, staggering. Think about it like this. An investor is playing the long game. They're thinking in years, maybe even decades. It's like they're planting a tree and are willing to wait for it to grow strong. But a trader? Nope. They've got a stopwatch out. They're thinking in seconds, minutes, hours, maybe a few days tops. It's a flat-out sprint.
So what does that actually look like? Well, for an investor, it means they're betting on the business itself. They're saying, I believe this company is going to grow, make more money, and become more valuable over the long haul. All those little daily price jumps and dips, to an investor, that's just noise. They're looking way past that, at the big picture.
The trader's mindset, though, is the complete opposite. It's all about speed. They aren't waiting around for a company to mature. They're jumping on market volatility, those short-term price swings. The whole game is to get in, get out, and capture a small profit, over and over again. We're talking about folks who might make tons of trades in just one day.
Okay, so this massive difference in timing, it naturally leads to the next big split, the tools they use. You can't use the same toolkit if you're looking for different things, right? And really, it all boils down to one question. Are you looking at a company's value or its price?
Yeah, their entire approach to analyzing a stock, it really just hangs on this one single critical idea.
And that's the difference between intrinsic value and the stock price. See, the stock price is easy. It's just what someone is willing to pay for it right this second. But intrinsic value, that's the company's real worth, based on its assets, its profits, its potential. And here's the key. Over the long haul, the price should catch up to the value. But in the short term, oh man, fear and greed can make that price go all over the place, totally disconnected from reality. And this is where they really go their separate ways. The investor, they're laser focused on that intrinsic value. Their entire mission is to figure out what a company is actually worth and then buy its stock for less than that. The bet is that eventually everyone else will catch on. The trader, though, they couldn't care less about intrinsic value. It's all about the stock price. They're just trying to guess where that price is headed, today, or maybe even in the next few minutes.
So, an investor's daily routine looks a lot like deep research. They're using what's called fundamental analysis. This means they're digging into financial statements, reading annual reports, trying to understand the management team, the industry, the whole shebang. It's slow, careful work, all with one goal in mind: figuring out that true intrinsic value.
Now, a trader's world looks completely different. Their toolkit is all about technical analysis. We're talking charts, graphs, and historical price data. A professional trader's day is spent staring at screens, looking for patterns, watching indicators that are supposed to predict what the price will do next. Honestly, for them, the mood of the market is way more important than the company's financial health.
And this leads to a pretty wild thought, right? A lot of traders, they buy and sell stocks without having a clue what the company even does. Seriously, because for them, it's not about the business. It's about the chart, the pattern, the price action. The company behind the ticker symbol, it can be almost an afterthought. Okay, this brings us to the last big difference between them: how they handle risk. And to get our heads around this, I think a good analogy helps. Let's think of it as a poker game versus a marathon. So the investor is our marathon runner. It's all about endurance, keeping a steady pace, knowing the finish line is way, way out there. But the trader? The trader is a professional poker player. It's a high-stakes game. You're trying to read the other players, place your bets, and make quick decisions with limited info. And that poker analogy really works when you dig into it. First, the stakes are incredibly high.
Traders often use what's called leverage, basically borrowed money, to make their bets bigger, which is great if you win, but devastating if you lose. Second, you're not playing against amateurs. You're up against pros, and even super fast computer algorithms. And finally, just like a hand of poker, there's always a bit of luck involved. You can be the best player in the world, but sometimes the cards just don't fall your way on a single trade.
All right, so we've looked at these two completely different worlds. What does this all mean for you? For the average person just trying to, build a solid financial future? What's the bottom line?
Well, the general consensus among financial experts is pretty clear. Look, can some people make a living as a trader? Sure, a very small number of highly skilled pros can. But for pretty much everyone else, the slow and steady, patient approach of investing is seen as the smarter way to build wealth over time.
And there are some really solid reasons for that. When you invest, you're basically riding the wave of the entire economy's long-term growth. Your decisions are based on solid research, not just blips on a screen. And, this is a big one, you're not trying to compete in a game that's often rigged in favor of super-fast computers and big institutions. When you look at the stats, the odds of building wealth are just better.
So to wrap this all up, maybe the best question to ask yourself is this. When it comes to your financial future, are you trying to play a high-stakes game of poker, or are you training for a marathon? Because the answer to that question really says it all. Thanks for tuning in.